Hello and welcome to Ask Bellco. This month we'll learn about the different mortgage options buyers have in today's market. And if you're a regular viewer on our show, you know that when it's time to talk mortgage, it's time to talk to Jamie Slavin, Bellco's mortgage sales manager. Jamie, welcome back to the show.
Thanks, Jack.
So we have talked a lot on previous episodes of the show about how hard it is to find a home in today's Denver market.
Yep.
And usually we talk about inventory,
yep.
right? But it's not just inventory, right? It's also because of rising interest rates and all sorts of other factors that go into that. So one of the ways to combat that issue, from what I understand, is you've described them as kind of like unconventional loans. Like I think before we started rolling, you were talking about combo loans. Can you tell us, like, what is a combo loan?
Sure. So, Jack, and before the camera started, we were talking about when you borrow more than 80% of your home's value, you have to have PMI or private mortgage insurance.
Right.
Well, so this whole idea around combo loans, and the reason why they're unconventional is just that most people haven't heard of them. So what we're talking about is where we take two loans, combine them towards one purchase. In other words, a combo.
Sure.
And by doing so, you don't have to have private mortgage insurance or PMI.
Oh.
So it's just a different way to structure your financing. We think at Bellco that it may be a smarter way for those in the right position to take advantage of maybe, we've seen sales prices in the fives and 600,000s in Metro Denver. And so one of the ways we see people structure their financing is they'll take one portion of money on the first mortgage. They'll take another portion on the second in order to avoid that PMI, as well as, let's say they expect a windfall of cash. Maybe they want to pay off that second mortgage later, and then they will have never had PMI all throughout their financing of their home.
Sure.
So again, it's kind of that we really want to find something that's going to be tailor-made to the member.
Right.
So that financing will fit them exactly.
And PMI, just to reiterate, is personal mortgage insurance?
Close. So private mortgage insurance.
That's what it was.
It is insurance that is there to protect the lender in the instance of a default. So meaning that if we can't pay our bills anymore and have to sell or foreclose on the home, the PMI or the private mortgage insurance would go and make the lender partly whole. So it's kind of a misnomer that it protects you as the buyer or the
right.
lender.
When you hear insurance, you feel like, okay, I'm insured.
But really, who is protecting is the lender.
And is that if you were going to pay PMI, that's monthly, like with your mortgage, usually lumped in, I assume?
Yep. Every single month. There's a couple of ways that you can cancel it. It's a little bit convoluted. So really, for the purposes of our show here today, I would say if you are in that segment, please reach out, 1-800-CALL-BELLCO. We'd love to help you through what that looks like. But really, for the purpose of today, it's really about just a subtle, different way to structure your financing so that maybe either A, you can afford more home, or B, you've got more discretionary spending that's not going towards your housing payment every single month.
So basically, you're reducing in some way or another that mortgage payment, or maybe using the same amount of payment to buy a larger home or a nicer home. Am I picking that up right?
Exactly. Exactly.
Okay, so that sounds smart. It sounds like a combo loan would be a good way to avoid paying the PMI. So are there different kinds of combo loans, or do I just walk in and say, give me the combo loan, or?
Yeah, so, and again, it's not going to be for everybody, but the two most common types that you're going to see, and it's a numerical expression, so bear with me for just a second. The first of which is an 80-10-10, and what that stands for is 80% of the purchase will go on the first loan, 10% of the purchase will go on the second loan, and then the last 10% is your down payment.
Okay.
So that's an 80-10-10. That's probably the most common structure that's out there.
Yeah.
Another one that's a little less common, but we're seeing more and more of it on the rise, is an 80-15-5. And if you think back to the example that we just gave, 80% will be the first loan, 15% would be the second loan, and then the 5% down payment would be coming from you.
Sure.
So again, it's just two different ways to structure your financing. You could also just do that as a 90% one loan. Now, in that instance, it would require PMI, and that's really the subtle difference that we're talking about.
Okay, so then just a couple of questions. I'm going to go a little off script here, but just a couple of questions then, because in both of these, one loan is like 80% of it. Does anybody ever be like 40-40? or something similar? Or is there a reason you would do almost all of it on one loan and then a small amount on a second loan?
Yeah, so there's several reasons, and we are seeing more types, like you're alluding to, like a 75-15, 10, right? That would be a structure that would be very similar to an 80-10-10, but by doing it as a 75-15, you may gain a price advantage with the investor with whom you're transacting. So you come to Bellco. Bellco has rates and fees, and based on your credit and your overall loan to value. So how
we've
much?
Talked about that before.
Yeah, right. And so if I do an 80-10-10, it may have a different price connotation than that straight 90% loan or a 75-15-10. And so really, again, it's about having that right discussion with a trusted advisor and making sure that they know all the motivations that you're acting under, and that we can make sure that we build those into the financing that we tailor for you.
Speaking of motivations, one motivation to do a combo loan would be to avoid the PMI. In what other ways do combo loans kind of save you money?
Yeah, so another way they save you money is maybe you've got a project that you want to build a garage in the backyard after you've purchased the home. The way that this would save you money would allow you a little bit more flexibility around that one project, rather than lumping it all in to where your primary home's financing occurs.
Sure.
I think the other big way that it saves you money is really around the whole aspect of PMI.
Right.
We always hear about mortgage interest tax deductibility, and most people think, and rightly so, that if you were to take a home equity line today, that it would not be tax deductible, unless you are doing it in connection with purchasing a home. So if you have a purchase money home equity line of credit that you're using to secure the purchase of that home, the first and second up to $750,000 are tax deductible. Now, you should always consult the tax advisor to make sure that you're acting in accordance, but we know that that is something that's out there, and so that's a way that you save significant amounts of money.
That's one type of unconventional loan, but I hear about other types of unconventional loans, and one of them that I hear is the ARM, which I think is adjustable rate mortgage, right?
You got it, yep.
Okay, awesome. Yep. Yes, I got one. Okay, so why choose an ARM over, for example, a combo loan? Yeah,
so I wouldn't say maybe over a combo loan, but maybe in connection with a combo loan.
Oh, you can do them both?
Yeah, and so think of it just like how we were speaking about this before. If I'm on a 30-year fixed and it's got a commensurate rate that's maybe a half a point or 3/4 of a point higher than what an ARM is adjustable rate mortgage.
Okay.
The most common types of adjustable rate mortgages are 3, 5, or a 7-year adjustable ARM.
So I just want to take a stab at this. So every 3, 5, or 7 years, your interest rate will adjust. Is that correct?
So you're close. So, but flip it on its head. Okay, so the 3 would signify for how long that ARM is fixed.
Okay.
And then it can change. In the instance of a Bellco, it can change once per year thereafter. So 3, 5, or 7 years, right? You would be fixed for 3, 5, or 7 years. The way to avoid seeing the rate go up, right? Because it's a variable rate mortgage.
And do they always go up? Do you ever see them adjust down?
Yeah, we do. So the one time that most recently that we saw them adjust down was not the greatest of times, right? It was after the Big Short or the big housing crash.
Right. Yeah. My dad calls that the funny money years.
Yes. Yeah. Yes. Right. And so, for instance, I had an adjustable rate mortgage on my home that's in Arizona, and for I will say up to a year and a half after the crash, my interest rate continued to go down on my home. Okay. That was a sign of other catastrophic things.
Right, exactly. It was good for you, but not great for the economy.
Correct, correct.
But most of the time, it seems like they're going to tick up.
Likely they'll go up.
So I kind of sidetracked you there. You were going to tell us how to avoid that.
Yeah, so the way to avoid it really is if you know that it's a 3, 5, or 7 year ARM where it's fixed, then before that 37th, 61st, or 85th month, right?
Right, 3, 5, 7.
Yep. Then you would look to refinance or have your financing structured differently before you get into that adjustment period.
Okay. So I think I'm basically asking the same question, but is there a way that I can make sure that, like, my payment, my monthly payment, doesn't affect my ARM?
So your monthly payment will be somewhat affected by which arm you choose and for how long it's there.
Okay.
Right? The amount of the payment that you have on your second will stay somewhat static. So with Bellco, we've got a choice line where you can take a 20-year fixed payment option, you can do a 1% repayment option, or you can look at an interest only. And again, just as a quick refresher, we call it the choice line because it's all about the member's
Your choice. And you get those options.
Right.
Sure.
So with the ARM, I think, and much like with many of the things that we've discussed, Jack, is it really emanates from the discussion, right? Let's get to know you, let's figure out what's going to work best for Jack, and then let's structure the financing type that's going to fit your lifestyle the best. Mm-hmm. Right? I think that's the way that we land on a successful transaction.
Yeah.
It's not a one-size-fits-all in mortgage. It's highly nuanced, and so I couldn't encourage people enough to go out and get that professional advice, whether it's from their internal board of directors or from a trusted advisor like one of the folks down at Bellco.
Yeah. Well, you know, and I agree with you. Just hearing you kind of describe combo loans and adjustable rate mortgages, it seems like there's a lot of variety out there and a lot of options for people. And I know that, you know, we do this show for people I feel like who are kind of like me, who when all the numbers and terms start going around, you know, my head's kind of starts to spin. I got to really laser in to track it down. So I think for folks at home, the important thing to remember is that you don't have to let all this confuse you. You can take your time and you can talk to your financial advisors, or I love, again, that internal board of directors. I really love that idea. So stick with that. Any final thoughts you want to share with us, Jamie?
You know, I would say more than anything, Bellco is part of the local community. We've been here since 1936. We really want to just sit down, get to know folks a little bit better, and provide any level of education or engagement that might help them make the best next decision around finances.
Yeah, absolutely. Well, you heard it here, folks. Swing by Bellco and talk to them about any of your mortgage needs. Maybe you'll even talk to Jamie here. Jamie, thanks so much for coming on the show.
Thanks, Jack.
Pleasure to see you. Yep. And thank you guys for tuning in. Now remember, if you have an idea or a topic that you want to see discussed on our show, just send it to us using that hashtag AskBellco on social media. Next month, we will discuss the most common types of financial fraud, yikes, and what you can do to protect yourself. We'll see you then.